The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
The Federal Reserve taking another step to try and curb inflation after CPI data came out yet again with some brutal numbers. So they're raising the Fed funds rate by 75 basis points on Wednesday. Higher rates, of course, strengthens the U.S. dollar, and that hurts digital assets. So joining us now to discuss all of it and explain it is none other than CoinDesk Indices Managing Director, Jodie Gunzberg. Welcome, Jodie. Good morning.
Good morning. Thanks for having me.
So, obviously with these higher rates, we're seeing some, and the U.S. dollar now at levels, U.S. dollar index at 19, just about 19-year highs. That's really crushing some digital assets over the past several weeks. What's going on, and why?
As you mentioned, the CPI announcement that came out last week was a pretty high number, 8.3 year over year, which is, I think, a little more than most expected. But the reaction by the Fed to raise 75 basis points in response to it was completely expected. So most of the drop happened already in that past week. But, generally, rising rates and a strong dollar is not good for the economy, productivity. It's being exacerbated by, high inflation in Japan, but they're not fighting it with raising rates, at least yet, or it doesn't seem that way. Europe is facing possible recession, and they've got really high inflation from Russia's attack on Ukraine, which spiked energy prices. So, all of this is driving the dollar probably even higher than just a regular rate hike would, because they are so aggressive. It's just driving demand for the dollar, which is obviously not good for crypto.
So what's interesting, and we have this chart up here, is that when it comes to crypto, when it comes to digital assets, it's not just it's not across the board even. Some are being hurt more than others. Some are performing better than others, but they all seem to be down. What's going on? Why is it affecting sectors within crypto differently?
The high inflation, the rising rates, a strong dollar, yes, it puts downward pressure on all of the digital assets, but it's not equally. Ether, which is the biggest asset in the smart contract platform sector, we see has lost about 22% from the CPI announcement. And we've got DeFi, which is largely built off of smart contract platform, down 17.5%, which is much more severe than the 13.5% drop that we're seeing from the CoinDesk Market Index, which represents a much broader measure of the market. But what I think is interesting here is that the culture and entertainment sector held up a bit better than most of the sectors, losing, just shy of 7%, but it actually outperformed a bunch of the equity sectors. So like real estate, materials, tech, communication services. Obviously, those are sectors that are really sensitive to interest rates, and high growth companies get hurt quite a bit when the Fed is working to slow down the economy.
So those culture and entertainment sector, that's the NFTs, that's the gaming, et cetera, correct? Sorry, I didn't hear you there.
The culture and entertainment sector has art, the metaverse, media, that includes the NFTs that I think a lot of us are familiar with. And, those are not as economically sensitive as something like DeFi or the currencies or the smart contract platforms that are just much more closely tied to the financial markets. And that's not dissimilar to the defensive sectors that we see again in the S&P 500. When we look at things like leisure and entertainment, gaming, there are more defensive characteristics there than there are in some of the more economically sensitive sectors like real estate.
So you're seeing that mirror. You're saying that it basically mirrors almost the equity markets now, that is matured, and therefore there is that fragmentation, that segmentation going on. And if that's the case, then how does one play the DeFi market? How does one play the economically sensitive sectors in crypto now that rates are going up?
Yeah, so we can start to segment, and you can create long short strategies, or you can create strategies that are overweighting the sectors like culture and entertainment, or even the digitization market. And then you can underweight the smart contract platforms and DeFis, which are really getting hammered in this economic environment.
So, Jodie, let's just look kind of more specifically at some of the digital assets in particular. So, there's that expression, rising tide raises all boats. And I don't know what the opposite of that expression is, like a sinking tide sinks all boats, but that's kind of been the vibe in crypto. So could you just break down, though, like, are there any digital assets that are sort of acting in an unexpected way, or, in some ways just defying the overall trend of the bear market?
I don't know that I've seen many surprises. Obviously, Ethereum held up much better than I might have expected because of the merge. And, what we're seeing, though, is strategies developing that the rising tide lifts all boats, and whatever the opposite of that is, creates momentum strategies. And you can actually see evidence because of the importance of community in crypto that shows up in the technicals, where momentum strategies going long and short based on the trend work. So I think that that's a development that we've seen pretty recently come out of this. And then, of course, we're looking at these sectors, and it's very difficult for a protocol in a struggling sector to do well. And sometimes maybe a protocol that's not all that great in a great sector, being just in the right time at the right place, will help it out. So sector momentum is something that is key to the investment strategy.
It's almost like buying
Jodie,
a terrible house in a nice neighborhood. I know you don't have a crystal ball on this, but you're so good on this topic. I just wanted to ask you, one of the big disappointments in the crypto industry has been how tied crypto has been to the equities markets. It's like, what's the point of crypto if it's just doing the same thing as the equities markets? And I'm just curious, in your opinion, like, what will it take for these two to sort of go their own separate ways?
Yeah, I think that we're going to need to see the macro environment calm down a little bit. I mean, in such an aggressively moving market the rate hikes are really severe, as is the inflation. So that very powerful macro environment is driving risk on assets. I mean, as the credit and the money that is less available for investment in any investments, that's going to pull back the whole market. So we need money to be a little more available and credit to be a little more affordable in order to get some of that extra availability for the investment. And then, of course, as the dollar maybe can come down a little bit, that would help. And then as the development, just as the market gets bigger, as we start seeing more derivatives come out, like we saw the derivatives on Ether come out last week, the options came out, then people will get more interested in investing because they'll be able to manage their risk. It's very similar to what we saw happening in the early 80s with the stock market options and futures that came out in this same environment, high inflation and high rates, aggressively rising rates.